You know what? Everyone wants to be rich, and most of those people would love to know how they can make money in the stock market. Well, I've got some news for you. It's not as easy as it seems. The truth is that stocks are scary, and they're even scarier when you don't know which company is good and which ones are bad. And that's where index funds come in. But are they really as powerful as Warren Buffett says they are? Are they good enough for your portfolio? Or should you be looking at other investments instead? I've already talked a lot about the power of index funds and specifically about ETFs, or exchange-traded funds. I think at this point, most people recognize that they are a powerful investment vehicle. But which specific ETFs are good to invest in for this coming year to set you on a path to financial growth? Well, I'm Kim, and in this video, we are going to look at a few awesome ETFs that you probably want to consider for your portfolio. Are you ready? Let's go! If you're new to this, let's start with defining the ETF. ETFs are a basket of stocks, bonds, or other assets that gives the investor exposure to a diverse range of assets. For example, ETFs can be structured to track anything from a particular index or sector to an individual commodity, a diverse collection of securities, a specific investment strategy, or even another fund. Unlike index funds, which are also a basket of assets, ETFs are flexible investment vehicles that are highly liquid. They can be bought and sold on a stock exchange throughout the trading day, just like individual stocks. Because investors can enter or exit whenever the market is open, and they can buy or sell as many shares as they want, ETFs are attractive to a broad range of the investing public, including active traders like hedge funds, as well as passive investors like institutional investors. ETFs are a great way to diversify your portfolio. They're also a great way to invest in the stock market without having to worry about choosing individual stocks or making complicated trades. So let's start with our top picks. I'm a big fan of renewable energies, as are most people. We're on track to abandon fossil fuels forever, right? Well, both Europe and the US are probably going to be abandoning petrol vehicles in the next couple decades. And this is a trend we're seeing in other industries as well. The problem is that there's no way for us to invest in wind power or solar without spending thousands of dollars on an index fund that covers everything. That's why I'd focus on a fund that covers a single type of renewable energy, like the iShares Global Clean Energy ETF, ticker symbol ICLN. It has an expense ratio of 0.42%, and it covers an index of global equities across many renewable sources. You can also invest in healthcare without having to spend hours researching companies that make medical equipment. The Nasdaq First Trust Clean Edge Green Energy Fund, ticker symbol QCLN, is a great way to do so. It has a low expense ratio of 0.1%, which means your money will go farther than you might think. And it's not just any fund, it's the only green energy ETF in existence. The reason this industry is growing at such a rapid pace is because people are living longer and healthier lives. Thanks to advances in science and technology, healthcare has become more accessible thanks to advances in technology such as Obamacare, which have made healthcare more affordable for everyone, from newborns to seniors. There's also an influx of new investors who want the opportunity to place bets on both black and red at the same time with their investments. The Healthcare Select Sector SPDR Fund, ticker symbol XLV, is one way to do so, as it includes stocks like Johnson & Johnson, Pfizer, and United Health, among others. The fund has a low expense ratio of 0.1%. You'll be able to put your money where your mouth is. Okay, those are all great. But now, it's time for my number one ETF, based on the S&P 500. This is basically the American economy, and that's why it's pretty hard to beat. The Vanguard S&P 500 fund, ticker symbol VOO, is a solid choice with low fees. The Schwab fund, ticker symbol SWPPX, is another great option. Both have low fees and are solid funds. I didn't include any real estate funds in this video because the housing market is a little uncertain right now and prices are all over the place. You can learn more about that in my separate video on real estate investing. So you might still be wondering if you should go for an individual stock or an index fund like the S&P 500. Jack Bogle, the founder of Vanguard Group, argues that everybody dreams of picking stocks like Apple or Google and making money from day one. And he's probably right. But, as he also says, we shouldn't rely on individual stocks alone. Instead, we should follow an index fund and own the whole market. Warren Buffett says if you invested $10,000 in the S&P 500 in 1942, you would now have $51 million. In other words, we are going back to the beginning. Index funds solve the two main trading problems: what to buy and when to buy it. Of course, there are some cons to keep in mind. Probably the main one is that index funds and ETFs don't allow for granular control over which companies you're investing in. But that is sort of the point, right? You're putting your money on the entire market, not just one company. Of course, you can always supplement your index fund strategy with a few specific stock picks, but I probably wouldn't make those the cornerstone of your portfolio. The main thing is to always keep learning and building your financial knowledge and understanding. That is why I'm a big proponent of reading books that provide key insights on how to both manage your money and invest for the future. If you'd like my top 3 recommendations on books to help you level up your financial future, then click on this video. See you there!